Hi, this is Jim Lee of StratFI, and I'm here to walk you through our market update for the second half of 2017. We'll talk about some of the risks in the market, what's working, what isn't, and we'll also show you where to find some of the best opportunities for growth going forward. Stocks have been somewhat range-bound since the beginning of June, but the trend is still very much our friend at this point. This market rally has been in place for a long time. Now, due to seasonal weakness that we often see during the August through September timeframe, it wouldn't surprise me if we saw a pullback down to the lows of April, which would be about a 4 percentage point drawdown. But frankly, I really don't see it getting any worse than that. Barring any major surprises, we're going to end this year in good shape. Now, it's also worth mentioning that volatility has almost entirely left the scene, with the S&P 500 now with price swings of about 16 points per day, or about half a percentage point. It's like we're seeing managed levels of volatility. There's just a lot of healthy skepticism in the markets right now, which is keeping things from bubbling over too much. Now, this is interesting stuff. The Philadelphia Federal Reserve now tracks something called the Partisan Conflict Index, which tracks the level of political disagreement among U.S. politicians based on keywords found within U.S. newspaper articles. This index typically spikes during presidential debates, healthcare reform, any discussion about the debt ceiling, but lately, under the present administration, it has been hitting new highs. Now, oddly enough, since the 1980s, returns for stocks have been twice as strong during periods of controversy than they have been when this index is at levels of 100 or below. And it's a bit counterintuitive, but it seems that stocks does better when Washington is in gridlock and fails to pass new policies. But the real beneficiary here of U.S. political stalemate seems to be the rest of the world. So if you look at this, the dollar has been tanking since the beginning of the year. Meanwhile, international stocks have been on a tear, with the MSCI EFA and the MSCI Emerging Markets Indices up 15 and 20% respectively since the beginning of the year. Yeah, so foreign diversification is finally starting to pay off after years of creating portfolio lag. But there are some other very good opportunities out there. So this is a market map with data on 500 different companies in one snapshot, and green is good and red is bad. And you can see that the energy stocks and the telecom stocks, which are both typically good for generating dividends, lagging this year. So that's the only two segments of the market that are in the red at this point. Meanwhile, it's all about tech all the time. Roughly a third of the S&P 500's returns this year came from the big five, being Google, Facebook, Amazon, and Apple. Quite simply, you have to own technology in this market. Healthcare is my second favorite sector, particularly biotech and medical devices. So it looks like we're in good shape this year. I expect a very small amount of volatility over the next 2 months, and consider buying quality on the dips. So this is Jim Lee with StratFI. If you have any questions, feel free to call me or send me a note. My email is jlee@stratfi.com.